Good morning, everyone. My name is Adam Livingston, and I am your number one source for Bitcoin and Bitcoin Treasury company analysis. Right now, we are gearing up for Phase 2 of Michael Saylor's plan for total capital world domination. And I want to give you my take on what will be happening with STRD and the amazing task they will be undertaking. Thank you so much for being here. If you'd like to hear more cutting-edge analysis on the greatest wealth transfer in human history, please like this video and subscribe to my channel in order to support my work. Please leave a comment with what you'd like to hear me comment on next. And remember, none of this is financial advice. This is financial entertainment. Welcome to the bond market's favorite horror story. The one where the protagonist isn't a central banker or a Goldman partner, but a 60-year-old executive chairman who somehow stumbled upon monetary alchemy, weaponized it, and embedded it into a NASDAQ ticker. This is STRD. Today, we're not talking about Bitcoin in the abstract. We're talking about what happens to price discovery when a publicly traded company stops playing by the old rules and builds its own monetary engine inside the US equity stack. You've heard of black holes in astrophysics. STRD is one in finance. A recursive capital sink that converts debt into Bitcoin with the grace of a hedge fund and the soul of a monetary insurrectionist. We'll break down the Trident, STRK, STRF, and STRD, the three-headed preferred equity monster that harvests yield-starved capital from dying fixed income portfolios and deploys it into the hardest assets known to man. Each issuance is a liquidity siphon, each tranche is a Trojan horse. And each coupon check sent to investors is just a bribe to keep them distracted while their money is quietly converted into cold storage satoshis. The market loves it, they're getting yield, they think this is just a clever carry trade. But what they're underwriting is a structurally reflexive bid that never sells, never sleeps, and never stops buying Bitcoin until it owns the marginal price. So strap in, this is the sovereign slipstream where the safe asset isn't treasuries, where the reserve currency isn't USD, and where the monetary policy meeting takes place not in DC, but in Tyson's Corner, Virginia, between Michael Saylor and Fong Li, which might as well be divine revelation. Let's talk about the Trident, the three-headed instrument piercing the jugular of the global debt market, one yield-starved asset manager at a time. At first glance, these might look like vanilla preferred shares, STRK, STRF, and STRD, harmless acronyms like something your CFA prep guide skipped because it assumed you'd never try to recreate the monetary base using enterprise software. Each one calibrated to pull capital out of a broken system. STRK is the seducer 8% coupon plus an equity kicker, a convertible with just enough upside to lure the dopamine-addicted pension manager who still believes in convexity. STRF is the brute, a 10% straight coupon because sometimes all it takes to hypnotize a bond fund is 2 digits, and STRD is the shapeshifter, designed to be economically equivalent but with flexibility to match funding conditions like a yield-seeking predator. Now here's a part that should send a chill down your spine. Every single dollar raised goes into spot Bitcoin within days. No diversification, no pause button. The moment the check clears, it becomes collateral, frozen in time, immune to dilution, and destined to reinforce the next raise. And as the collateral pool grows, the next issuance gets cheaper. Why? Because auditors are signing off on BTC cost basis. Because the market starts pricing in reduced credit risk. The same dollar that just bought Bitcoin is now backstopping the next coupon offering. It's an auto-cannibalizing yield engine that gets stronger with each feed. The Trident doesn't just fund Bitcoin purchases, it forces them. Every raise increases demand. Every demand increases perceived collateral equity. Every improvement in collateral quality lowers funding cost. And this loop keeps tightening until one of two things. One, the bond market collapses, or two, STRD owns a statistically significant portion of the money supply. Here's where things go from clever to carnivorous. Welcome to the synthetic yield honey trap, the part of the machine designed specifically to lure institutional capital into underwriting their own obsolescence. Picture the average fixed income desk in 2025, drowning in negative real yields, choking on treasury duration that nobody wants, high-grade credits that yields less than inflation, and along comes STRD offering 8%, 10%, even double-digit paper secured not by junk bonds, not by real estate, but by appreciating collateral sitting in cold storage. This is yield with a tailwind. Investors get paid a coupon, but the underlying asset appreciates while they sleep. It's like buying a bond whose collateral is melting upward. That should not exist, but it does because Saylor reverse engineered it using the only monetary assets that does not degrade. And the trap, once the capital flows in and BTC hits the balance sheet, the risk profile actually improves. The collateral pool grows, duration risk drops, liquidity coverage ratios strengthen. So the next time they raise, the coupon doesn't have to be 10%, it can be 9.75 or 9.5, and they still get oversubscribed. Because the asset now has momentum and institutional capital, like any form of life, chases heat. This flywheel doesn't spin because it's fast, it spins because it's reflexive. Safer collateral leads to cheaper coupons allow for bigger raises, and bigger raises buy more Bitcoin, locking in stronger collateral for the next round. This is what Wall Street calls innovation when it works for them and Ponzi dynamics when it doesn't. But it's not a Ponzi because there's no counterparty risk here. The yield is paid, the Bitcoin is real, and the only people crying foul are the ones stuck holding 1.6% 10-year paper that doesn't even keep up with CPI lies. It's a liquidity death spiral for every competing yield instrument. And once you've tasted yields with built-in capital appreciation, good luck going back to municipal bonds and bedtime. Now here's the flow we just talked about. This strategy raises capital via preferreds. The capital buys spot BTC, no futures, no rehypothecation, just raw on-chain absorption. And what happens when you keep removing coins from a supply pool that's already issuing at a fixed terminal rate? You soak the float, there's less liquidity for everyone else. You distort the marginal price and you start shifting the market center of gravity toward your own balance sheet. Now Bitcoin goes up not because of hype, but because there's mathematically less available to trade. With a higher BTC price, Strategy's net asset value expands, their existing holdings get marked higher, and that in turn lowers perceived risk for the next round of capital raise. Every basis point they shave off the cost of capital means they can raise more and buy more, creating a collateral feedback loop that no traditional capital allocator understands until it's already too late. It's the same reflexivity that Soros wrote about, except the feedback loop isn't based on human emotion or settlement. It's not a housing bubble, it's not .com paper. It's cryptographically scarce collateral being recursively monetized through equity markets at institutional scale. And that's the game, the monetization executed through a balance sheet that's now acting more like a vacuum pump than a public company. By the time anybody's going to realize what's happening, the market isn't reflexive, it's captive. And Saylor is the captor. You're now looking at a balance sheet pretending to be a company but functionally operating as a shadow central bank. Strategy has transcended corporate finance. It doesn't manage cash, it manages monetary gravity. It's a synthetic monetary policy engine and it's already live. Let's decode it. Each preferred issuance, STRK, STRF, and STRD are forms of reserve creation. These are synthetic dollars, liquidity conjured from the bond market's despair and instantly collateralized. There's no roll risk or no swap desk. This is final settlement. The coupon level, that's the policy rate. Too much capital chasing issuance, drop the rate, tighten the spread, and let the yield curve invert in our favor. Market demand slacks off, hike the coupon, widen the net, and reel in the capital flows like a sovereign liquidity trawler. The issuance cadence itself becomes open market operations. When Strategy wants to tighten liquidity, they pause, stop issuing. Let the market breathe. When they want to expand, when the BTC price dips or conviction wavers, they reopen the vault and release another preferred. And that new issuance soaks supply, uplifts price, strengthens collateral, and spins the flywheel all over again. The policy target isn't CPI, it's not employment, it's not some politically compromised macroeconomic Frankenstein number. The target is the Bitcoin spot print. And if that number doesn't behave, the balance sheet does. It's an unregulated monetary authority, only this one doesn't inflate away your savings, it accumulates them. And this is why Strategy will have more power than world governments. This is the fulcrum, the Rubicon, the exact point where Bitcoin's price discovery ceases to become democratic and becomes monarchical. What you're looking at is the collision of two forces, the absorption line, Strategy's daily OTC Bitcoin demand, and the distribution line, the sum of total miner issuance, ETF outflows, and every half-broke trader who thinks he can time the top with RSI and gut instinct. And when those lines cross, when absorption consistently exceeds distribution, the rules change forever. Because now every seller in the market, every ETF rebalancer, every leverage degen, every desperate miner paying off an electricity bill in Kazakhstan is effectively negotiating with a balance sheet that never sells. You can't reason with it, you can't intimidate it, you can't front run it, You can only capitulate to it. This is the moment strategy becomes the marginal price setter. Not just an aggressive buyer, not just a large holder, but the gravitational center around which every market maker begins to quote. Because Saylor's OTC price isn't just a bid, it's a commitment backed by a reflexive capital engine, collateralized in real time, and funded by a tap of the preferred equity ATM. It's the only quote in the market that doesn't flinch during volatility because it's not trying to arbitrage, it's trying to absorb. And once that line is crossed, Coinbase is no longer price discovery, Binance isn't either. They're just reflections of OTC demand from a balance sheet that's slowly nationalizing monetary policy through capital market mechanics. And the real tragedy, nobody can stop it. There's no off switch, no regulator understands it. No bond fund can boycott it because the yield is too good. And every time someone tries to sell into it, they're just feeding a machine built to never give the coins back. This is the end of the open market and the beginning of monopolized absorption, and it's being executed in broad daylight by a man with a Twitter profile picture that looks like he's seen God and decided to buy more Satoshis. This is where the physics of liquidity bend around strategy's balance sheet like space-time curves around a black hole. Every OTC print, each direct Bitcoin purchase becomes a gravity well. Price begins to orbit it. Derivatives start to pin to it because it's not just a spot buy, it's a statement. This is the new floor and we're not leaving. And as those OTC prints stack, something else happens. The optionality embedded in STRK, the convertible, starts losing its teeth. Implied conversion prices creep further into the future. The threat of dilution, which should spook equity holders, starts to fade, not because it isn't real, but because the asset's base beneath the equity keeps getting stronger. That's the paradox. The more aggressive the market anticipates dilution, the more they front-run the next issuance. Traders start bidding futures before the SEC filing even hits Edgar, because they know more BTC is about to be bought, so they push up the price, which inflates the NAV, which reduces perceived dilution, which delays the conversion, which makes the whole capital structure more valuable. It's an options theta burn, but it funds Bitcoin absorption. The longer the market stays nervous about dilution, the further out the conversion horizon stretches, and the more dry powder strategy can extract from the new preferreds issued at lower coupons. Thanks to stronger collateral form, you guessed it, the very Bitcoin the market priced up in anticipation. The feedback loop eats its own tail. Liquidity isn't just reacting to issuance anymore, it's anticipating it. And in doing so, it's subsidizing the next block of permanent BTC absorption. More capital, less cost, stronger war chest. This is Gresham's law, but not the textbook version. This is Greshams Shadow, the darker, more systemic variant. For 40 years, the bond market was the cathedral. Sovereign debt was sacred. US treasuries were risk-free because you could always print the interest. But now we're in an era where capital understands yield and capital understands decay. In sovereign debt, that's bad money. It yields less than inflation. Its purchasing power is eroded by design, and its principle is collateralized by political dysfunction. Strategy's preferreds obliterates the very assumptions underpinning them. Pensions and insurers will start rotating voluntarily into the Trident stack. Not because they love Bitcoin, not because they believe in Saylor, but because they're hemorrhaging time value in a portfolio stuffed with negative real yielding government debt. Capital migration doesn't feel dramatic, it feels like rebalancing, like prudent diversification. But it's actually a slow motion margin call on fiat, a controlled demolition of the global debt standard, executed one pension reallocation at a time. Capital obeys incentives, and the incentive now is scarcity plus yield, not lies plus coupons, not CPI-adjusted fantasy metrics, just pristine collateral and terminal scarcity bundled into a structure that renders the old benchmarks irrelevant. This is where we're going, and it's not a dream, it's a terminal trajectory with no external constraint. Let's fast forward a couple years or less. Strategy holds 1 million BTC, that's about 5% of the total supply, not of circulating supply, total. These aren't trading positions, these aren't ETFs vulnerable to redemptions. This is cold storage collateral, state-grade monetary weight, held by a public company operating as a self-refinancing liquidity sink. Through a steady expansion of the preferred stack, let's say 12 billion outstanding. And could it be a hell of a lot more than that? Absolutely, and it will. Not convertible debt with kill switches, just high coupon equity hybrids priced for a post-sovereign world. Coupons not funded by cash flow, but through treasury management arbitrage. The float is gone, the coins are gone, and what's left isn't being sold, it's being priced. And here's the final shift. Bitcoin starts trading on Saylor Risk Meetings, on the projected cadence of this balance sheet. When will the next issuance hit? How much preferred capital is still left to deploy? What's the NAV cushion? What's the implied dilution timeline on strike? This is how bonds trade around the Fed. Now Bitcoin does the same, but the Fed is a Virginia-based software firm, running monetary operations on a schedule they'll never totally disclose. Welcome to a world where corporate treasury is macro policy. And make no mistake, this isn't a sideshow, this is the market. Strategy no longer reacts to Bitcoin price, it sets it. Every S3 filing becomes a macro signal. And the irony, the more capital flows in, the harder this structure becomes to stop. This is the sovereign-grade, post-nation-state financial organism that I have warned about. And it's still filing 10Qs like nothing's happening. Wall Street is asleep and they're still whining on X about MNAV multiples like it's a Bitcoin ETF. Here's what matters. Watch absorption versus distribution. That's the battleground. On one side, daily miner issuance, ETF redemptions, panic sellers, and macro tourists trying to hedge CPI prints. On the other, strategy waking up every morning and removing liquidity from the global float with surgical precision. When absorption exceeds distribution consistently, price discovery is over. The bid is structural, it's recursive, and it's engineered to never reverse. Track coupon compression. Every single basis point shaved off the preferred yield is a signal that the market perceives lower risk, that the collateral cushion has grown, that the system is being rewarded for its own hunger. They are thermometers for imminent BTC absorption. And finally, understand that every preferred sold today is a prepayment on tomorrow's supply shock. That capital will be converted into cold storage BTC. That BTC will not be sold, and the existence of that bid will distort every model, invalidate every trading range, and render your RSI chart as useful as shares of MySpace in 2012. This is a new monetary axis forming in real time. It's not decentralized, it's not proof of stake, it's not controlled by a DAO with a logo designed by a guy in Bali named Chad. This is a precision-engineered capital deployment with the explicit intent to capture a terminal percentage of the global monetary base, and to do it before the institutions even figure out what they're looking at. So stay long, stay loud, and respect the Trident, because the next Bitcoin all-time high won't be set on a Coinbase chart. It'll be set during a boardroom conversation at Strategy when someone asks, how many more coins do we want this quarter? And the answer will be all of them. Thank you for listening to this presentation on how strategy will rule the monetary world. If you enjoyed this ultimate bull fuel, please like this video and subscribe to the channel. Class dismissed.